understand the core concepts and ideas discussed on the TV show Shark Tank India. We will cover here the most important concepts that are useful for people looking out for a career in entrepreneurship and startup, or working in the domain of product management, business, economics, or finance. So without any further ado, let's start. As a prerequisite, before even raising funds, company should be registered under Ministry of Corporate Affairs and should have necessary licenses. For example, Food Safety and Standard Authority license for food businesses, Import-Export Code for businesses doing import and export, Shop and Establishment Act for business looking out for starting restaurants or any shops for commercial reasons, GST registration, and so on. Also, you can register your company's trademark, as trademark is an intellectual property which differentiates companies' product and services from the competitors. And registering the company's trademark ensures that no one impersonates your product and services in the market, and you secure your company's intellectual property. The entrepreneurs should have a business plan and a pitch deck ready around the idea that they are going to present to investors prior heading in for a pitch. Now, before looking into the details of a business plan, we shall discuss the company's foundational step. One of the important things before evaluating any company is understanding its mission and vision statement, and also understanding the story or journey of the founders before coming up with the idea of starting up the company. It is to understand the direction where the company or the individuals are heading and whether their story, mission, or vision statement resonates with you. Now, one should also understand the essential difference between the mission and vision statement. While vision is more aspirational and focuses on the long term or the bigger picture, since it's a long term, it more or less it doesn't change for any company or organization or an individual. It serves as the ultimate destination. For example, here is a vision statement by Alzheimer Association, a world without Alzheimer disease. While mission statement on other hand contains all the achievable ambitions for the product in a simple and concise way, mission statement deals with the how part. That means it focuses on the current and medium to short term goals that ultimately will help in realizing the product vision. For example, the mission statement for the company Honest Tea is to create and promote great tasting, healthy and organic beverages. Once you have the mission and vision statement set for your company, then most important thing is how you will connect, which is what strategies you will have in place to achieve your company vision using your company mission. The strategy is built around the goals that you want to achieve within a particular time frame, which could be monthly, quarterly, or annual. The goals could be, for example, how many customers you plan to reach, or how many sales you want to make, or milestones that you need to achieve to reach your goal. So basically, the strategy includes series of ways or direction that you're gonna take under various external circumstances to achieve your goals. It includes thinking through the various potential risks that could appear in the near future and planning out mitigating steps that you are gonna take to overcome those risks and keep moving forward towards your goal. It requires thorough understanding of the market and competition analysis and defining the path that you are gonna take. And then comes the execution, in which you implement the strategy, which includes steps to make to reach your destination of achieving your product vision. In this, you will be executing the goals that you have defined as part of the strategy that needs to be achieved to reach your product vision. So having defined the mission, vision statements, strategy and execution, you have laid out the foundation for the company. And all these are part of business plan. While business plan also includes some other components which we are going to discuss next. As part of your business plan, you should clearly define what products and services you intend to offer and why there is a market for it. It should also convey what experience and expertise that you possess to offer these products and services. You should highlight a focus on the customers, as they will be the end users for your products and services. Here you can also define USP, which is unique selling proposition, which defines your product and brand apart from competition. USP also guides your branding and marketing decisions. Your unique selling proposition should be unique in terms of providing value to the customer. A well-defined and captivating USP is assertive in nature, but also you should be able to defend it based on your data and research, which we will see in the coming sections. The business plan also includes the market analysis about the demand and supply, competitive landscape in which you intend to market your product and service. It's a good idea to do a SWOT analysis and include it in your business plan. A SWOT analysis is an analysis of your strengths and weaknesses and about external opportunities and threats. SWOT analysis is a proven method to identify your market position, which will help you develop your strategic goals and shape your current and future execution or operations. A SWOT analysis consists of a 2x2 matrix in which you need to identify and write down your strengths, weaknesses, opportunities, and threats. You need to optimize your strengths and leverage the opportunities while work on your weaknesses and take care of the threats. Here, strengths and weaknesses are something internal to your company or organization, while opportunities and threats depend on the external circumstances. Here in the strengths section, you need to define your capabilities and advantages and resources which are internal to your company. It includes what are the things that you are doing better compared to the market. It may give you your unique selling proposition as well. Within the weakness section, you may look out for things that you lack or things that you need to improve. It may also include the things that competitors are doing better. These weaknesses are something internal to the company that includes the limitation, disadvantages or vulnerabilities that needs to be identified and worked upon. Now within the opportunities section, you may want to figure out what are the development chances are there that could benefit the company, the things that you might do differently to capture the market or industry trends to meet your strategic goals or at least to attract a wider and larger audience base. These are the external opportunities that are based on the current environment or the market landscape. And last, within the threats section, you may need to identify the risks and external effects or obstacles that may arise. For example, direct or indirect competitors or shrinking trends or diminishing market. It may also include privacy concerns or concerns related to government or regulatory approval, or is there any need for any licenses that may require to do the business. Also, it may include the concerns related to website or app security, anything that may affect your position in the market. A SWOT analysis framework is a very good tool to understand and evaluate a company's competitive position in the current market, and also to develop the strategic planning goals that may help to achieve the company's vision. As part of the business plan, you need to have your financials well defined, which may include the revenue model, that is how you intend to make money off your solution, which includes the products and services you sell. For example, is it subscription model, or is it based on direct sales, or is it ad based? You need to understand and include the information of the revenue models which you intend to use. The aim of including financial information is to showcase the company's ability to grow and develop into a financially healthy business. You may include 3 to 5 years of projections showing how fast and how much you can scale. Also, you can include the information related to top cash burn while also explaining the rationale behind it. For financials, you can include the hard numbers as well as the estimations for future based on your data. One should also understand some of the basic accounting terminologies that are also the important metrics to understand the company's financial health. Number 1 is revenue, which is the total amount generated by sales. It can be calculated by multiplying the average sales price by number of sales. Second is cost of goods sold. It includes all the cost that is involved in producing the goods. It may include raw material cost and labor cost. Gross profit is calculated by subtracting the cost of goods sold from revenue, while gross margin is nothing but the gross profit in terms of revenue percentage. Another important metric is operating profit or operating income. It is calculated by subtracting the operating expenses from the gross profit. Operating expenses may include any expense related to business operations. For example, rent, utilities, employee salaries or employee benefits, and insurance premium. However, it doesn't include interest paid on debt and company's taxes. And operating profit margin is nothing but the operating income in terms of revenue percentage. One important thing to note here, both gross margin and operating income have to be looked on to understand the company's financial health. Because a company can have high revenue as well as high gross margin but may have low operating income. It may be due to a lot of cash burn. So that's why both the metrics need to be compared to understand what's going on internally. Now if you look at the definition for assets, assets are the resources which are controlled by the business. It could be of two types, tangible and intangible. Tangible assets are assets which are of physical in nature, for example machinery, physical items, vehicles, inventory and so on. While intangible assets are non-physical in nature, for example copyright, patents, brand identity and so on. Now all the assets, even as small as coffee vending machine, has been given value in the business balance sheet. Now liabilities for the company is the total value that the company must pay in short term or the long term. It could include loan, mortgage or rent payment and so on. It includes all the debts that company is having. Assets can also be divided on basis of liquidity, that is how easily it could be converted into cash. If it can be converted in cash within 1 year, they are called current assets. For example, cash or cash equivalent, stock inventory available for sale, or money invested in liquid fund, or any amount or money to be received in short term. All those are current assets. While long-term assets are fixed asset. For example, land, property, machinery, equipments. Similarly, current liabilities are the current portion of the long-term debt that has to be paid within the next 12 months. For example, a 10-year loan consists of 9-year long-term liability, while 1 year which has to be paid for the current year is the current liability. Similarly, wages or salaries to be paid to employees which has to be paid in the current year are also part of the current liability. Last, shareholder equity is the money that is attributed to the shareholders. It is also equivalent of net assets after liabilities have been deducted from the assets. As we have seen earlier, shareholder equity is equal to net assets when liabilities have been paid off. Shareholder equity can also be broken down into 4 categories. It's a combination of common shares, preferred shares, paid-in capital, and retained earnings. Now, common share represent the ownership in the corporation. These are the most common shares that are traded in the stock market. Common share have higher return potential due to capital gain, but they also have higher risk as well. Common shareholders gets the voting right on the corporate issues, but when it comes to the dividend payments and claim over company's assets and income, preferred shareholders are given priority over the common shareholders. The preferred share also represent the ownership in the corporation, and the rate of dividend is also fixed for the preference share. That's why it's low risk compared to the common share. The preference share typically give the fixed income, however the return potential of the preference share is low compared to the common shares. Another important term in corporate finance is share capital. Share capital is equivalent of combination of common share, preferred share and paid-in capital. The paid-in capital is also known as contributed capital. It is equal to the excess amount that the company receives for the common share on top of its face value or par value at the time of its issue. Now the amount of the net profit which is left with the company after paying out its taxes and dividends is known as retained earnings. It is combination of the previous year retained earnings and the current year's net income after taxes and paying out the dividends. Now the company can use this amount for various purposes, for example reinvesting in the company, equipment, R&D or in marketing. Here dividend means the distribution of the company's earning to its shareholders, and it is determined by the company's board of directors. Now let's discuss two of the commonly used terms in the corporate accounting, which is depreciation and amortization. Now both of these terms represent one common thing, which is the reduction in the value over the period of time, while the difference is depreciation talks about tangible assets. Depreciation is the estimated reduction in the value of fixed asset within a financial year. There are various methods to calculate depreciation. One of the commonly used is straight line depreciation method, in which the cost of the equipment is divided over its useful time. For example, if a machine has a lifetime of 10 years, then dividing its cost by 10 and then reducing that each year is the calculation which is given by the straight line depreciation. While amortization is also reduction in value, but it applies to intangible assets like copyrights and patents. These intangible assets also have limited lifespan. So if company owns some intangible assets that will eventually wear out and become obsolete, then it can also be calculated under amortization. For example, if the company has $5,000 of loan and company pays $1,000 of the principal every year, which means $1,000 of the loan has amortized each year. EBITDA, which stands for earning before interest, taxes, depreciation and amortization, is another important financial metric which is used to evaluate company's operating performance. It is basically an indicator of company's capability to sustain its profitability, as it is independent of company's capital structure. EBITDA is calculated by adding depreciation and amortization element to the operating income. A financial plan has three major components, which are cash flow projection, income statement, and balance sheet. A balance sheet contains details about the company's assets and liabilities and shareholder equity at any given point of time. Balance sheet gives important snapshot of the company's capital structure and financial information at any given point of time, and during fundamental analysis of the company, balance sheet can be used to calculate the financial ratios. The balance sheet ratio basically indicates relationship between two items in the balance sheet. These ratios are useful in analyzing the company's financial stability, risks associated, and the expected returns. For example, debt to equity ratio. This ratio basically compares the company's total liabilities with the shareholder equity. It is calculated by dividing the company's total liabilities by its shareholder equity. Basically, it gives information about the degree to which the company is financing its operations based on debt instead of using its own resources. Debt to equity ratio is used to determine the company's financial leverage. The financial leverage means the use of borrowed money, which is the debt, to finance the purchase of assets with the expectation that the income or the capital gain generated from the new asset will exceed the cost of borrowing and there will be net profit. Debt to equity ratio vary depending on the industry. However, there should be a balance, as very high debt to equity ratio indicates there is lot of debt that will pose higher financial risk, while low debt to equity ratio is also not good because it doesn't offer the financial leverage, thus limiting the profitability. Also, one more ratio, for example, is asset test ratio, also known as quick ratio, which basically indicates whether the company has the sufficient short-term assets to cover its immediate liabilities. This ratio gives information about the financial condition of the company. Quick ratio is calculated by dividing the quick assets, that includes cash and account receivable, by current liabilities. Another ratio is the working capital ratio or the current ratio. Like the quick ratio, this also looks how well a company can pay its existing debts. However, it considers the current assets rather than simply liquid assets. So current ratio can be calculated by dividing the current assets by current liabilities. Another important ratio is the return on equity ratio. Return on equity ratio basically gauge the company's profitability and also how efficiently the company generates the profit. It is calculated by dividing the net income by shareholder equity. Now, for example, a 15% ROE indicates that the company earns rupees 15 on every rupees 100 of its share capital. Return on equity ratio is also known as return on net assets, as shareholder equity is equal to company's assets minus its debt. Another interesting ratio is the inventory turnover ratio. This ratio shows how many times a company turned over its inventory in a given period of time with respect to cost of goods sold. For example, consider a company has sold 40 crores of goods in a year, while the average inventory for the year is 4 crore. So in this case, inventory turnover ratio will be 10. That means company was able to clear the inventory 10 times in a year or in every 36 days. Well, these were some of the important ratios. However, there are many other ratios that can be computed from the balance sheet that are useful to understand the company's financial health. Another major component of the financial plan is the income statement, which shows how the company has experienced profit and loss over the given period of time, which is generally 3 months. It is also known as company's P&L statement or pro forma statement. It basically has the information about the cost of goods sold, operating expenses such as rents and utility, amount of net profit and loss and gross margin, and also revenue streams, which is typically in form of sales. Earning per share, which you can find at the bottom of the company's income statement, is a measure of company's profitability. It is calculated by dividing the quarterly or annual income minus dividends by the number of outstanding stock shares. The higher the company's EPS is, the greater will be the profit and the value perceived by the investors. In short, we can say earning per share measures the net income that you will receive for each share of the company's stock. Now, another important term that could be derived from the earning per share is the price to earning ratio. Price to earning ratio is a valuation metric, that is, it is the ratio for valuing a company that measures the current share price relative to the earning per share. This metric helps investors to assess how expensive a stock is. Another major component of the financial plan is cash flow projections. As the business runs on the cash, it gives information about the cash inflow and cash outflow. Cash flow projection, which is also known as cash flow forecast, involves estimating the cash coming in and going out based on past business performances. It gives information about how much cash is available at any given point of time, where it is going, and from where it is coming from. Now, once you have understood the basics of the financial plan, you can check out various templates for the financial statements and understand how the calculations are done. The business plan also consists of one more important section, which is marketing plan. Marketing plan is a well-crafted roadmap covering all your marketing strategies and tactics. This marketing portion of the business plan covers 4 important topics, which you can call 4 P's. That is product, price, promotion, and place. Now, talking of the product, it talks about like what is the USP of your product, how it is different from the competition, and why people should buy it. Price section will include the details about the price which the consumer is willing to pay for the product in the market. The place, which includes which sales channel you are gonna use, a place where you can put your product forward to the target customers according to their budget and price point. You can also call this P as distribution, how you are gonna distribute this product to the consumers. It includes the details of the activities, how easily a product can reach to the potential customers. Promotion section will include information about the promotion that you are gonna use to reach your potential customers. It includes promotional activities that communicate the product features and benefits to the customer and persuade them to buy the product. Promotion basically encapsulates or binds together the first 3 P's, which is putting out the right product at the right price, right place, right time. Marketing plan includes details about your market research and market analysis, who will be your target customers, what competition is in the market, what are your strengths and weaknesses, and so on. And you will also include the details about the marketing strategies that you are gonna take to reach to the potential customers, which is what strategies you are gonna take to differentiate your business from your competition. Also details about the sales plan, like what promotional activities or advertisement activities you gonna have to achieve your sales target. One of the crucial component of business plan is executive summary. Executive summary briefly gives information about your business idea, the problem that you are solving, and the target market that you are capturing, along with some necessary details such as financial numbers and projections. The aim of executive summary is to briefly and concisely give the most important information about your business in a quick, simple, and effective way. Executive summary is around 1 to 2 pages. Once you have the business idea about what products or services you want to sell, the first thing is to test out your assumption and validate whether your product and services actually meets the market need. You want to make sure that you are spending your time and resource wisely in building what actually works in the real market. So you may want to validate your product and services as soon as possible, because there will be higher loss and cost implication if you identify incorrect assumptions or flaws in your product and services at later stages. So in early stages, once you have discovered the idea that you want to build on, you want to quickly roll out minimum viable product by gathering the feedback from the potential customers in your target market. So once your minimum viable product is out in the market, You may want to gather feedback as much as possible from the early adopters of your products and services and keep making improvements and rolling out the next versions. You may want to iterate this process couple of times to get the best product market fit. By gathering the initial customer feedback and response to initial versions of your product and services, you will be able to gauge the market demand, and accordingly you can decide whether you want to keep moving forward with your products and services or want to drop the idea. Product market fit basically demonstrate that there is a demand in the market for the product and services that you are offering, and people are actually getting value from it and they are willing to pay for it. Product market fit basically demonstrate that there is a demand in the market for the product and services that you are offering, and people are actually getting value from it and they are willing to pay for it. You may find your product market fit before going for the fundraise because it indicates the profitability and scalability that your business can reach, as it shows that what problem you are actually solving and whether there is a market for it or not. Product market fit indicates company's ability to scale and grow, as it is an amalgamation of different things which indicates company's long-term success and sustainability. It is indicated by a good distribution, that company's ability to reach its potential customers in the target market, customer retention and the customer order repeat rate, and also good unit economics. Unit economics involves dealing with numbers to analyze companies' cost and revenue on basis of per unit of item sold. Now, since this cost and revenue are involved with the per unit of item sold, it can be used to calculate or project gross profit when the business scales. Having positive unit economics is very essential to measure the business success and predict the company's financial stability. Unit economics basically compares the customer's lifetime value to the cost of acquiring the customer. Now, customer acquisition cost, which is CAC, is the amount of money spent on sales and marketing to acquire one customer, while lifetime value is the average amount of money that company earns from per customer during the entire lifetime of relationship. Now, for example, if you talk about subscription business, for a given period of time, churn rate will be the percentage of customer who cancel their subscription during this period, while retention rate will be opposite to the churn, in which like customer that remain subscribed during the period is the retention rate. Now, in this particular case, the average customer lifetime value will be calculated based on the customer that stay subscribed before they churn out. Unit economics metric can be calculated by subtracting the customer acquisition cost from the lifetime value. When lifetime value per customer is greater than the customer acquisition cost, that is the sign of good or positive unit economics. Now, knowing lifetime value per customer and customer acquisition cost is also important because it helps make the projection in future for the break-even point. Break-even point is the point at which the total cost and total revenue are equal, which means no loss or no gain. So total profit at break-even point is 0. It is only after the break-even point when companies start making real profit. Now, lower break-even point indicates that the business is better in terms of financial stability and profitability. That means company will reach profitability in shorter time. You can have various metrics to measure product market fit. One of such metric is Net Promoter Score, NPS. NPS score can vary from -100 to 100. To calculate this score, you ask your customers to rate your product between 0 to 10. The customers who rated your product between 9 and 10, they are the promoters of your product. Basically, they will give the positive word of mouth and help your product go viral. They are the loyal customers. And the customers who have rated your product 7 and 8, they are passive. They are neither promoter or nor they are detractors. They are passive or neutral. While customers who have rated between 0 to 6, they are the detractors. These are the people who don't like your product and can even give negative feedback about it. To calculate NPS score, you subtract the percentage of detractors from the percentage of promoters. In calculation of NPS score, you do not take into account of percentage of passive customers. Basically, when you launch your product and services in the market, you start by a net promoter score with being 0. So NPS score of around 50 is actually good indicator that you have reached the product market fit. in which like 75% people are the promoters and 25% people are the detractors. So you can have such metrics and keep track of them and keep optimizing it to reach the product market fit. Now, one of the technique or framework that is used to evaluate a startup worth for investing or not is T5 model. The T5 model includes the 5 factors to evaluate whether to invest in a startup or not. These are number 1, total addressable market, number 2, team, number 3, timing, number 4, technology, and last, number 5, traction. The total addressable market refers to the total demand that product can generate. Higher the total addressable market, higher will be potential for scale and thus generating more revenue by reaching more customer in the market. Team is one of the important factor for startup success, as a solid team indicates efficient execution of the strategic goals. A solid team means having trustworthy people with complementing skills and relevant expertise that would support the business. Timing, which is also one of the critical element in the growth and success of the business, which means like launching your product at the right time at the right place, in which there is a need and a strong demand in the market. Timing is also important to reach the untapped market at the right time, which has the higher potential of exponential growth in future. Technology, which is one of the important factor for startup growth and success. It includes having the necessary infrastructure and platform to reach to the potential customers. Technology also means having the innovation or improvement in your product that enhances its efficiency and performance, and thus it becomes the USP for your product and services. Technology basically enables to do more in less amount of time. Thus, it is one of the important factor to evaluate a startup's scalability. And traction, which indicates whether the customer are actually using the product or not. It means the momentum that the startup has got in the market after introducing its product and services. Traction basically means growth and progress, which is evident by the financial numbers. So all these factors are important to evaluate whether a startup is worth investing or not. Initially, the startup founders run their startup on bootstrap. That means they use their own personal finances or borrow money from friends and relatives or use the operating revenue to establish their product and services in the market and validate their idea. To scale and grow the company, funding is required. Funding is basically raising the money to scale the business by spending that money on marketing, growth and operating expenses in order to increase the revenue and also the profit. Now investor invest money in the startup and get some percentage of ownership in the company in form of equity. The ultimate aim of the investor is to get the return on investment over the period of time. Now there are various stages of funding which are also called investment rounds. It starts with the early stage seed round, in which fund is raised to basically establish the proof of concept or product market fit and establish your product and services. It is followed by funding rounds named as Series A, B, C, D as the company scales. As the business is scaling, the company needs more money to scale further. Now to scale further, the amount raised is invested in building strong teams, operations, marketing, and launching new products and services to attract more customers and thus increase the revenue. Now with each round, the valuation of the company as well as the amount that is raised through funding increases. Well, startups having the business model with lot of growth potential can get funding from the venture capital firms and angel investors. An angel investor usually provides some money or capital in exchange of equity or in form of convertible debt, which is a loan given to the startup that can be converted into equity at later point of time based on the terms and condition of the note. And the term venture capitalist refers to the investor who work for a venture capital firm. A venture capital firm maintains a fund known as venture capital. It is a kind of a private equity fund that invests in a high growth potential startups for return on investment. Apart getting funding from angel investors and venture capitalists, there are other funding options as well, such as taking a business loan or having a grants from government organization or other institution for startups having idea for the societal development, or raising money from incubators and accelerators or crowdfunding. All these are various options by which a startup can raise funds. Well, the startup sells stocks to investor in order to raise funding. Now the percentage of equity that investors get is based on the valuation of the company. Now, for example, if a startup raises 50 lakhs of capital in exchange of 10% of equity, that means the company has the valuation of 5 crore. That is the worth of the startup for 100% of the stocks. Two most commonly used terms in a startup valuation are pre-money valuation and post-money valuation. Pre-money valuation refers to the estimation of the company's valuation of equity prior to the funding round, while post-money valuation refers to the equity or the worth of the company after the funding round has been completed. So post-money valuation is equal to the pre-money valuation plus the investment amount that has been raised. Now, for example, if a venture capital firm has invested $5 million for the 10% stake in the startup, then post-money valuation can be calculated by dividing the finance raised by percentage of equity ownership. In this case, it is 5 divided by 10%, which is equal to the $50 million of post-money valuation. So initially, when the company is founded, the founders of the company own all 100% of the company's issued share. So for example, initially the company issued 1 lakh share, so all the share belongs to the founders. And as the startup is raising the funds, this equity is getting diluted. For example, if a startup raises 20 crore of funding in exchange of 10% of the company equity, then post-money valuation can be calculated dividing 20 by 10%, which is 200 crores of post-money valuation. And pre-money valuation can be calculated by subtracting the amount raised from the post-money valuation, which is 200 minus 20 crore equal to 180 crore of pre-money valuation. Here share price can be calculated dividing pre-money valuation by the existing number of shares. Here it is 180 crore by 1 lakh of the outstanding shares. So each share price comes about around 18,000 rupees. Equity dilution happens as the startup issues 11,111 new shares, which is in proportion to the funding raised, that is 20 crore. Now, equity dilution is unavoidable during fundraising, but as the number of shares owned in the company establishes the ownership, so it is very crucial for the founder to ensure that their equity is well protected. So it's crucial to know how much cash a startup needs at present time and refrain from raising more funds than required to safeguard the company's ownership or equity. Last but not the least, one of the important component of business plan is exit strategy. It is a part of the financial section of the business plan. Basically, an exit strategy gives the business owner a way to reduce or sell their investment in a company, especially if the company is successful, then make a sizable profit and get a return on their investment. Some of the well-known exit strategies include merger and acquisition, which means getting acquired or merged with big company in which investor gets a chance to sell their shares. Well, another well-known exit strategy is selling your stake or share to the partner or to the other investor. And the most popular one is going public, in which company goes public by listing on the stock exchange by launching an IPO, which is initial public offering. It is a process of selling the new share of the private company to the general public. An IPO can be part of a private investor's exit strategy, in which there is a lock-in period, and after the lock-in period has passed, private investor can sell their private equity to the general public. So these were some of the well-known exit strategies. Liquidation and bankruptcy are two of the exit strategies for the worst case scenario. Liquidation is the process of closing the business and selling the assets for paying to the creditors and shareholders in order of their priority. Liquidation can be voluntary, but it is triggered when the company is unable to pay its debts. And last, bankruptcy, which is a legal process in which people or entities who cannot pay their debt to the creditors can seek a legal proceeding to start fresh by forgiving the debts that they can't pay. The downside of the bankruptcy is that it affects the credit score of the person or entity and the reputation as well. Meanwhile, the creditors will get a chance to get some of their repayment by the process of liquidation. Startup valuation is one of the important process before going for funding and raising capital. It basically tells investors what is the true worth of the company that they are investing in. There are some popular methods out there by which the valuation of the company can be estimated. These are cost to duplicate method, discounted cash flow method, Berkus method, and market multiple method. We will learn about all of them in the coming section. Now, cost to duplicate method for startup valuation accounts for all the expenses that were incurred for establishing the business. which includes cost for product development, cost for physical assets, and if it's a software product, then it includes total cost for programming time that has gone into the coding and designing the software. Similarly, for R&D company, it includes all the costs that went into research and development, patent protection, and prototype development. All these costs are added up to find out the valuation of the startup. One of the major drawbacks of this approach that it doesn't account for intangible assets like brand value and team strength that has been established in the market. Also, this approach doesn't account for the future potential of the startup as it is highly subjective and difficult to predict. Another method for finding out the valuation of a company is the discounted cash flow method. This method calculates the investment value based on the anticipated or future projection of the cash flow. Typically 3 to 5 years of projections are taken into account because beyond that it's really hard to predict what will be the future cash flow look like. Now, since these projected cash flows are based in future, they can't be used for finding out the valuation of the company. So they are discounted back to their present value, and the summation of the discounted cash flow gives us the valuation of the startup. Now the discount rate that is used is based on multiple factors such as the market risk, the amount of debt that company is having, and return that company needs to generate. We will see how it is calculated in the coming section. Here is the generic formula for calculating the discounted cash flow for n years. N could be the period number, which includes the number of years for which the cash flows are projected, and R is the discount rate, which is the rate of return used to discount the future cash flows back to their present value. Now, before learning about how to calculate discount rate, we need to learn about two of the important terms that are used in discount rate calculation. These are cost of equity and cost of debt. Cost of equity is nothing but the return that company needs to generate on its equity to the investors to justify their investment. So one of the well-known method, which is capital asset pricing model, is used to calculate the cost of equity. Basically, this model tries to estimate the return needed on equity given an amount of risk involved. Now the following equation can be used to calculate the cost of equity. The terms that are used in this equation are risk-free return rate. This is the minimum rate of return that investor can get without any risk. The government treasury bill is considered as the safest investment, and the interest rate that it gives can be considered as the risk-free return rate. The term beta here represents the systematic risk, which is basically the volatility of the asset with respect to the market. If beta is less than 1, that means asset is more volatile relative to the market. If it is 0, then the asset is neutral. And if beta is greater than 1, that implies that the asset is more volatile in relative to the market. The term MRR represents the market rate of return. It is the rate of return of the comparable asset in the free market. Now, when we subtract the risk-free return rate from the market return rate, then we get the market premium or the equity risk premium. This equity risk premium is the excess return that an investor earns by investing in the company compared to investing in the risk-free asset. So higher the risk, higher will be the beta and higher will be the market premium. Thus, it will result into high cost of equity, which implies higher return to justify the risk on investment. Now, company can also raise capital by taking the debt in form of business loans or by issuing bonds at the fixed interest rate. Now, cost of debt is nothing but the effective interest rate that company has to pay on all of its debt that it has taken. Here is the equation given for simple cost of debt, which is taking the business loan at particular rate of interest. So multiplying the loan amount by rate of interest will give us the simple cost of debt. Now, these interest expenses on the company debt can be tax deducted as they are considered as business expense and can be used to save tax. Now, cost of debt after tax amount can be calculated by multiplying the simple cost of debt by 1 minus tax rate. This tax rate is the rate at which the business is taxed. When company takes loan and use the money correctly, and the loan amount can generate the net income which is greater than the cost of debt after tax amount, then the loan taken is advantageous or beneficial. And finally, cost of debt after tax rate can be calculated by dividing the cost of the debt after tax amount by the total debt that the company has taken. This is the effective interest rate that business needs to pay on all of its debts. One important thing to note here, the loan amount will get amortized, which means it will reduce after each installment payment. Now, as the company capital structure consists of debt as well as equity, so for the discount rate, weighted average cost of capital is used. The weighted average cost of capital illustrates the required rate of return for an investment in the company, which has both debt as well as equity in its capital structure. As we have seen earlier, the discount rate is applied on the projected future cash flows. Here, cash flow implies the free cash flow to the firm. The free cash flow to the firm describes the money that is left over for investors after the firm has paid all its expenses, taxes, and invested in short-term assets like inventory and long-term assets like equipments. So free cash flow to the firm belongs to the bondholders or creditors who have given the loan or debt to the company and shareholders who have invested in the company equity. Here is the formula for weighted average cost of capital, in which cost of equity is taken in proportion to the equity percentage and cost of debt is taken in proportion to the debt percentage, and both are added together to get the final weighted average cost of capital, which will be the discount rate for the calculation of discounted cash flows. Here is the example of discounted cash flow, in which an initial investment of 15 lakh is made in a project and cash flows are projected for the next 5 years. The discount rate is 8%, and the third column shows the discounted cash flow, which is calculated on top of projected cash flow based on the discount rate. Adding all the discounted cash flows for 5 years, we get the final amount, which is the discounted cash flow sum of 15 lakh and 14,996 rupees. And when we subtract the initial investment, which was 15 lakh, from the discounted cash flow sum, which is of 15 lakh 48,996, we get the resultant net present value, that is 48,996 rupees. Here net present value is a positive number. The positive number implies that the money generated in this project is more than the initial investment. Higher the amount of net present value, higher will be the return on the investment. Another integral part of the discounted cash flow method is the terminal value. The terminal value gives the value of the company beyond the forecasted cash flows. Since it's really hard to forecast cash flows beyond a certain period of time, there are two methods are used to calculate the terminal value. These are perpetual growth method, or it is also known as Gordon growth model, and second way is exit multiple method to calculate the terminal value. Now the perpetual growth method, which is used to calculate terminal value, makes an assumption that the business will generate the cash flow at the constant growth rate forever after the period of projected cash flows. Here is the formula for calculating the terminal value using the last projected free cash flow to the firm and then multiplying it by 1 plus growth rate and dividing the result by difference of discount rate and growth rate. The second method for calculating the terminal value is the exit multiple method. The exit multiple method assumes that a business will be sold, so in order to calculate the terminal value, it takes a financial metric like company EBITA and multiply by it a factor to get the terminal value. Now this factor could be derived from the similar firms that were recently acquired. The calculated terminal value has to be adjusted to the present value using the discount rate of the last projected year. We can use the discounted cash flow formula for adjusting the terminal value to the present value using the discount rate of the last projected year, which is N. And last, enterprise value, which is the value that estimates the potential acquisition cost. It is based on the capital structure of the business, which could be derived by adding the equity value and value of debt and subtracting any cash or cash equivalent from it to get the total enterprise value. The enterprise value can also be derived from the discounted cash flow method. As we have seen that discounted cash flow method has two parts. The one is the projected cash flows for n years and second one is the terminal value. Now enterprise value can be calculated by adding the sum of discounted cash flows for n years and adding the terminal value, which is adjusted to the present value, to get the enterprise value. Here is an example to calculate the enterprise value using the discounted cash flow method. Here the cash flows are projected for the 3 years and sum of discounted cash flows for all the year is given as 1,27,000 rupees. The weighted average cost of capital is 10% and last forecasted free cash flow is 60,000. The growth rate for calculating the terminal value is given 4%. Now to calculate the enterprise value, we will first calculate the terminal value using the formula of perpetual growth method, and it comes out to be 10,40,000 rupees. Now this terminal value has to be discounted to the present value using the discount rate for the last year, which is the third year, and the adjusted terminal value to present comes out to be 7,81,367 rupees. Now the enterprise value is the sum of discounted cash flow for all the years and adjusted terminal value, so which is 1,27,000 plus 7,81,367, which gives the enterprise value as 9,08,367 rupees. Berkus method is another method that is used for finding out the valuation of early stage companies or startups. It basically examines 5 important factors or areas in the company and study these factors quantitatively as well as qualitatively and assign some value to each of them, and sum of values of all the factors result into the startup's pre-money valuation. So the 5 factors or the study areas are good idea, which means having the basic value which serves as the foundation for the startup. After that, having the prototype or technology or infrastructure to support the startup scalability. Then having the strong team with complementary skill sets that will help in the execution of the strategic goals of the startup, followed by having the strategic relationship or market value that will help in getting more clients or partnership for growth of the startup. Last, having the existing customers or sales number which indicates the startup is production ready to get their products out in the market. Market method is another method for startup valuation. This method makes an assumption that similar companies or similar assets should be priced similarly. So in order to evaluate a company's worth, this method analyzes the financial information from the comparable companies. In this, we can compare the financial ratios between the comparable companies. Traditional businesses are frequently valued at multiple of their EBITA. So EBITA could be compared between the similar companies. For example, if 2 similar companies are compared and one companies have valuation 5 times of the EBITA, which gives an indication that the valuation of other company could be around 5 times of the EBITDA. Likewise, startups are typically valued at the multiple of their revenues because startup in the early phase typically experience significant losses as significant amount of money gets invested in the operations and setting up the infrastructure. So instead of EBITDA, revenues are used to compare the similar companies. Now the relationship between the company valuation in terms of multiple of these financial metric is determined by the industry or business model or growth rate and other arbitrary factors like team strength or their level of experience or likelihood of the disruption by the startup. All these factors contribute in the valuation of the startup. Let's have a look on the term cap table. What is the cap table for the company? It is a table with all the details of the equity holders and their ownership percentage in the company. Cap table is also known as capitalization table. It evolves over time as new investors are added and equity dilution happens. Cap table includes the authorized share details, which is the total number of shares that company legally issues to the investors, but it also further classifies the company securities in form of common stocks, preferred stocks, stock options, and also details who owns them. It also have the details of the shares that have been fully diluted, which includes outstanding shares, which are the company stock that have been currently allocated to the shareholders, plus additional shares that might result from if all the convertible securities of the company are exercised, such as stock options and warrants, etc. Employee stock options are used to attract the prospective employees and to retain the current employees. Stock options are like a reward. It gives employees the right to get some shares after a certain period of time. Founders and investors should keep the cap table up to date. That gives founders enough incentives for them to stay motivated and keep working in the company's success, and also having the flexibility to add the right investor at the right time in order to move the company towards growth and higher valuations. Term sheet is also often used while fundraising. It is a non-binding agreement that outlines the terms and conditions of an investment. It is used to speed up the negotiation so that each party, which are the company and the investor, should evaluate the terms and condition of the term sheet and agree on it to make sure everybody is on the same page so that the official contracts are prepared. Some of the details that term sheet includes is the company valuation, what is the investment size, how much stake percentage is exchanged for the fund, voting rights, liquidation preferences, anti-dilution clauses, and what will be the investor commitment. These are some of the things among many others that are part of the term sheet. The world is changing and constantly evolving. Thus, there is a need for business to adapt to the market landscape. So, due to this rapidly changing world, there might arise a situation when the business is not working as it should work. Then there is a need to reconsider the business model, to look out is there any need for change. The startup pivot basically involves a startup changing its business model by learning from the direct or indirect feedback from customers, or in response to market landscape or competition, or in case of financial crisis when the business model is not working, then there is a circumstantial need to change and adapt according to the market landscape. There are some fundamental things that are really essential for the startup or company success, which are also the foundation. And these are the things that investors also evaluate. However, these things are also important for the company stakeholders and founders to take into consideration while building their products and services. That is, having the expertise and credibility. Now, credibility is obtained by having the expertise to do something in the field that you are working on, having the necessary licenses and certification, and also the quality regulation that will benchmark your product and services and will raise the brand value. It also indicates to the customer that the company cares for them and takes necessary precaution in terms of the quality of their products and services, and also on the company side to consider user empathy while building the products and services and deliver the value to the customer, which is the foundation of product management. Once the foundations are set, then comes the sales technique, as typically cost of acquiring the customer is very high. That's why having the existing loyal customer is really important in terms of referrals that they can provide, and also the sales techniques such as upselling and cross-selling to the existing customers can boost company's revenue by increasing the average order value. Upselling is a sales technique that encourages customers to buy higher end of the version. It's like an upgrade to the product. Examples of upselling includes like when you have the annual subscription instead of having the monthly subscription due to the savings that it provides. Similarly, cross-selling is a sales technique that promotes accessories and other related product to the original product that customer intended to buy. Example of cross-selling is when you buy a laptop, you are also shown the accessories that you can buy along, such as mouse, keyboard, etc. Both cross-selling and upselling increase the customer lifetime value and boost the company's revenue. Also, it makes the customers happy as they get the added value or savings of their purchase. The important characteristics or qualities of a founder that investors look before investing is having the confidence, determination, and positive attitude to make their company success. It shows the passion that entrepreneurs have in achieving their dreams, irrespective of all the obstacles that they have to accomplish their goals, as these qualities are really important for anyone to do big in their life. Congratulations on completing the tutorial and following through. I hope that the thing that you have learned will give you new dimension and perspectives in thinking and to broaden the scope to do good in life.